Well.
I have a little bit of a breaking news alert for all of you degen Goonie traders. It looks as if President Trump is going to get his wish and the Fed is going to cut rates. But it's not going to be as big as Trump wants it to be. And I also in this video want to break down the details of why exactly it's happening now. But most importantly, I want to chit chat about what it actually means for the market, at least how it's played out historically, so we can best position ourselves to ideally make some tendies when we actually get the rate cut in mid-September. But of course, before we get into all those details, if you enjoy these type of market discussions and breakdowns, don't forget to like, subscribe, and turn on your notifications because it really does help get this video in front of other people who might want to be a degen Goonie trader with all of us. And with that being said, let's roll the tape. First is first, I want to give you the TLDR because I don't want to waste your time. I don't want to make you watch to the end of the video if that's not really what you're into. We are getting a Fed rate cut because the labor market is getting a little bit soft and inflation it's not really dropping, but it's not really rising either. We're going flat. So when it comes to the Fed's dual mandate, aka price stability, inflation, keeping it on that 2% target, and then the other part of the dual mandate, the second part, is going to be the labor market. The fact that inflation is coming in at 3, granted it should be 2, but we're pretty constant at 3, but we're starting to see an uptick in the weakness of the labor market. That's pretty much what's going to seal the deal on September 17th of giving us a 25 bips rate cut. So yes, we're going to be dropping from 4.25% down to 4%, which is still off of the entire 300 bips, aka the 3% cut that the president wants, but really it's because of the recent economic signs that we're going to get this rate cut. So very quickly, what does that mean for you? Well, it kind of means a little bit of choppiness, but I also want to get into seasonality. So in terms of the immediate reaction, it kind of depends on the context of why we're getting the rate cut. Historically, it hasn't been so good, but this time it could be a little bit different. But overall, prepare for a spike in volatility. And now for those of you who want to stick around and really get into some of those nerdy stats, facts, and figures with me, let's let it ride. Big shout out to public.com for sponsoring this portion of the video. You've probably heard me say it before and you're most likely going to hear me say it again, but if you're trading options and not using public.com, you're probably leaving money on the table. Public is one of the most cost-effective platforms out there. No commissions, no per contract fees, plus they pay you a rebate on every stock and ETF options trade. That's right, you earn between 6 and 18 cents per stock and ETF contract with higher rebates as you trade more. If you ask me, that's all great, but now the platform is even better. You could build a multi-asset portfolio with stocks, options, crypto, and bonds all in one place. You could take advantage of their tools, including a real-time options hub, a customizable chain, smart strategy builder, and even a queue so you can prep multiple trades and fire them off when they're ready. And for my systematic traders, Public's free trading API gives you full read-write access so you can automate your edge without paying a cent in commissions. If that sounds good to you, check them out at public.com/Matt Kohrs or hit the link in the description and you'll quickly learn why Public is my favorite. And of course, thanks again to Public for sponsoring the Goonie community. So we are currently sitting at 4.25%, and as of today, the odds of a 25 bips rate cut is skyrocketing to 95%, and we will get the decision at the September 17th FOMC meeting. And just because you're here in October, there's actually a 53% chance that we're going to have 2 rate cuts by then, and by the end of the year, there's actually a 44% chance that we'll have a 75 bips rate cut. So yeah, decent odds, but obviously there is, as of now, no odds whatsoever for a 300 bips rate cut. And I get it, there's a giant narrative right now of Trump screaming that Jerome Powell is too late and he's trying to kick Lisa Cook out of being a Fed governor, off the voting FOMC board, and all that good jazz. But at the end of the day, when it comes to you're trading in your investments, let's rely on the actual numbers rather than the narrative that mainstream media likes to spin, stuff that's actually measurable rather than just opinionated in a certain sense. So coming back to what in the world is happening today, why did the odds of a rate cut spike up today? Well, it's because of what we got at 10 a.m. Today, Wednesday, September 3rd, we got the JOLTS job openings, and the forecast was for 7.38 million jobs, and it came in at 7.18, as in a miss, as in not good for the job market, not good for the labor market, as in a weakening market. Remember, rewinding to what I said at the start of this video, the Fed exclusively has a dual mandate. Mandate number one, price stability. Keep inflation at 2% in the long term. Mandate number two is make sure the job market isn't in complete shambles. Granted, when we're on the price stability side of things, we're not really at our target, but you got to consider the other part of the mandate. And right now we're starting to get some numbers that suggest the job market is in fact weakening, which is basically saying, hey, we'll cut the rates a little bit because we still think it'll help with inflation, but we'll take our foot off the economy to allow the job market a moment to breathe. When this number came out at 10 a.m., we saw a big shift in the betting markets, if you will. So Poly Market right now has an 86% chance of a 25 bips rate cut at the September meeting. And looking at Kohrs, there's an 85% chance. So really from the start of the day until right now, but specifically because of that 10 a.m. announcement, Kohrs, Poly Market, and the Fed Watch 2 all agree it's pretty much etched in stone, as close to being etched in stone as you can without actually being etched in stone. So I just wanted to call that out. And the reason we're not at 99 or 100% is because for the remainder of this week, we do have still important things to pay attention to. So Thursday, September the 4th, we get ADP non-farm employment change. And then on Friday, we get the very important report of the non-farm payrolls and the unemployment rate. So if these things come in way better than expected, as in a super strong job market, well, the odds of the rate cut are going to drop a little bit. But if they come in at expectation or a little bit worse than expected, that's when we're probably going to see the event of going to 98, 99, 100% chance or odds, if you will, of a 25 bips rate cut once again at the September meeting. And now that we're all on the same page of most likely getting a rate cut unless craziness really plays out on Friday, what does this mean for the market? Well, first of all, here's a daily chart of the S&P 500. We're not that far removed from an all-time high, so overall higher highs, higher lows. Yesterday was a little bit sketchy, but we technically didn't break a recent low, so I'll be watching 6,344 personally, or break out to a new all-time high. But it's a little questionable. It's uncertain right now. It doesn't really quite know which way it wants to go. The Nasdaq a little bit weaker. We did put in a lower high, but same thing. We did not snap the 50 EMA and we did not make a fresh low. So yeah, overall, we did recently hit an all-time high, but recently it's a little bit more questionable. Bitcoin definitely showing some weakness, clear lower highs, clear lower lows, but a little bit of a bottoming here as we're starting off the month of September. But what I find to be the most interesting is the market is clearly moving from risk on to risk off. What in the world do I mean by that? Bitcoin taking a little bit of a hit, the Nasdaq taking a little bit of a hit, the S&P 500 taking a little bit of a hit. You know what's not taking a little bit of a hit? The safe haven asset of gold, which as I'm filming this, just hit a fresh new all-time high. For that to mean there's hitting a new all-time high, people are clearly moving money from the equities in the crypto market right into gold, and they're definitely doing this as yields are kind of spiking up a little bit. So right here, a classic sign of risk off, and gold is just absolutely ripping. So obviously that's all what we have going on right now, the measurable stuff, but let me give you a little bit of a history lesson. I went to old ChatGPT and asked the AI system, hey man, what commonly happens to the US stock market 1 day, 1 week, and 1 month after the first Fed rate cut after a long pause? You could read all this if you want, feel free to pause the video, but I really like the bottom line. So this is crunching all of the data because this is obviously publicly available, very easy to do research on. After the first cut, even following a long pause, the common pattern is a day of pop, modest 1 week fade, roughly flat 1 month on average, with outcomes hinging on whether the cut is insurance in a soft landing or a response to a downturn. So it's all with that final context. Are they cutting because they're worried about how bad things are and that's how the market's going to interpret it? Or is it just, hey, like we think we're doing pretty good and we're just doing this because that's what our model suggests and everything's going to be fine? It kind of depends on what bucket we're in. But once again, when you average all those numbers together on the announcement, the average result is a 1 day pop, 1 week giving a bit of it back, and then flat over 1 month. So now with that in mind, please keep in context the season in which we are in. Over the past 5 years, here's the monthly results, the seasonality of SPY. You can see September is by far the worst month of the year. And when we look at the weekly information, yes, pretty much all 4 weeks, actually not pretty much every single one of the 4 weeks in September over the past 5 years has been won by the bears rather than the bulls. So that means with the meeting heading into mid-September, things are going to be a little bit questionable. What is going to be the market's interpretation of why we're getting the cut? And then after that, is history going to play out in terms of the one-day pop being common, or is the history of a one-week drop with the week seasonality right now playing out in the same week? Putting that all together can actually prompt a lot more questions than it can answers, but when you consider the fact that the market is moving from risk on to risk off, i.e. we're seeing gold completely spike, and if you look at the options flow, a lot of people are starting to buy hedges as in either VIX calls or overall market puts, it tells me the market is expecting choppy waters ahead, which means please plan accordingly. Of course, these are all my own thoughts and opinions. Maybe I'm right, maybe I'm wrong, which is exactly why I want to hear from you and get your thoughts in a comment below. Do you think the market's going to continue its bullish ride to the upside, or do you think it's about to get chopped at the knees? Let me know in a comment below. That's what I have for you today. I'll catch you in the next one. Appreciate all the good vibes.